Yeah, my forecast is pretty much the same. I have raised targets in recent months, so my S&P target has moved up to 8,000 from 7,500. My Nasdaq target has moved up to 27,000 from 25,000. My Russell and Dow targets I have not changed. I may end up raising any of those four indexes going forward. I do believe we're in the final leg of what I've been calling a 42-year, now soon to be a 43-year secular bull market. So I think we're going to put in a top this year, could put it in by the end of the summer, could put it in this fall, but I think we'll probably see a top this year. And I think the targets I've just laid out are, if anything, conservative. So I'm pretty comfortable. I'm certainly the most bullish analyst on the street. There's, in fact, given what happened back in early April, a lot of people are pretty skeptical of this market. They turned bearish then, and that's what actually at the bottom is when, very close to the bottom is when I raised my targets, while everybody else on the street was lowering targets and saying the top is in. I was even going higher. So, and that's how I work. I mean, the sentiment was getting just so negative, and that's basically future buying power. So, I looked at it and said, no, we actually are going to have a bigger leg, this final leg. So, I call it a parabolic leg. I think it will, as it moves towards the top, get steeper and steeper until it actually is going vertical. And that's really why I argue that my 8,000 is a good number right now, but when you get into that final crazy phase where everything's kind of going up straight up, it's hard to pinpoint a number. So I'm comfortable with 8,000, but it could go to 9,000 for all I know. But it should be short term. It'll all happen pretty fast. In terms of bonds, which has been in the headlines a lot in the last few months, with people fearing that rates are going a lot higher. I think rates have peaked. I think we saw over a year ago, I think it was probably October of 23, that we topped out at over, at 5% on the 10-year, and worked our way down to under 4%, and then have bounced back to, went to 470, and now we're in the 440 area. I'm very comfortable with a bullish view on bonds. I think you're going to see a sharp decline in rates over the next year. Some of that will happen during this final leg of the bull market, the equity bull market, and some of it will happen when the economy rolls over and we're in what I'm saying is going to be a global bust. That's where you'll see the biggest move in rates down. But I do think you could, over the course of the next 6 months, see rates drop from the current 440 area down to as low as 2.5.
Okay. That might actually be your most contrarian call right now, it would seem, because I don't really see any other people who are very bullish on bonds right now. It seems like the consensus is either that rates are going higher or they're kind of just staying at this relatively elevated level like they have been for the last 2 years. But you're saying that it looks like maybe from a technical perspective that, like on the longer end of the curve, the 30-year and the 10-year probably topping out here and could roll over soon. And from that, you could get mortgage rates going lower, you could get auto rates going lower and things like that could almost be stimulative in effect.
Yeah, that's true. It's both technical and fundamental. I do think the economy is softening and will continue to soften through the summer. A lot of that is, I think, the tariffs and the adjustments consumers are making because of what will probably be higher prices. So we've got, first of all, people buying ahead of the tariff hikes, saying, I know prices are going to be higher, so I may as well buy now, whether it be, cars, appliances, bigger ticket items, or even some other things that are influenced by, clothing, et cetera, influenced by tariffs. I think that just naturally you look at it and say, if we're seeing, a stronger second quarter, a lot of that is that buying ahead of the tariffs. That only means that the third and fourth quarters could be lower, could be weaker. And I think that's part of it. The Fed is still restrictive. That's another part of why I think the economy can slow. And so, and the Fed, frankly, with the meeting yesterday, seems to be ignoring the weakness, because we're seeing weakness in spite of people buying ahead, in spite of the fact that the second quarter is probably getting some bounce from that. We are seeing under the surface, factory orders and ISM indexes and things like that are coming in pretty weak. Consumer confidence bounced, but I think will weaken again. So I think there are lots of fundamental reasons why rates can come down, as well as technical. My read of the technicals looks solid too. So, unfortunately, people get caught in thinking everything interest rate driven is driven by the Fed. So they pay attention what the Fed says and does, and that holds them to a view that rates can go up because the Fed's talking about not dropping rates here and watching for higher inflation, et cetera. So they're nervous. When you look at the sentiment on bonds, it's very negative. And I think that's, again, just like it was in the stock market, a sign of a bottom, not a top. So in bonds. So I think there's a big runway ahead in bonds. Stocks will outperform here through the summer, but bonds will be trading up, and then you'll have a real big move in bonds if and when the economy really starts rolling over hard. And so that's part of my bullish case for stocks is lower interest rates. I'm not worried that the Fed is not cutting yet. As I say all the time on X, the bond market tends to lead the Fed. So the Fed will follow along, and that will be added impetus for the stock market, I think, later in the summer. They will ultimately cut, I believe. They may not know that yet, but I'm pretty sure they will. But interest rates are coming down anyway, because the bond market will be moving up and driving rates lower.
Okay, that makes sense then. I mean, yeah, it is kind of another incorrect perception a lot of people have, is just that that all the rates are controlled by the Fed. No, it is just the Fed funds rate that they directly control. I'm curious with because you're forecasting this Meltup, historic Meltup, pretty much all equities across the board and bonds and gold and silver. So it sounds like pretty much every asset class rallying during that Meltup. But at the same time, you're seeing, and I see it too, just a lot of current economic weakness, probably, increasingly weak economy going forward. And it might seem like those two views might be conflicting, but you're actually forecasting a melt up in spite of that. So do you think investors are going to kind of be too optimistic in light of that? Like they'll see, oh, the Fed can now cut rates. It's a soft landing. That'll be kind of the whole narrative driving the melt up. And then, of course, fear of missing out and everything else that just contributes to momentum.
Yeah, exactly. I think we used to call it Goldilocks, or it's been called in the past the Goldilocks scenario, where you have a soft landing. So in investors' mind, even though I think we're headed for a hard landing, in investors' minds, the data will support a view of a soft landing for probably several more months, at least a few more months. And that will help bring rates down because it's soft. The economy is soft. That will help bring inflation down. I know that the Fed's very worried that tariffs are going to push inflation up, et cetera. I don't think you're going to see much of an uptick in inflation. And when you look through the numbers, I think you'll see plenty of reasons, particularly in the housing area, to continue to say it looks like inflation's trending towards their target. So you'll have that, and the companies have continued to show resilience in terms of managing their earnings. Quarter to quarter to quarter, everybody keeps thinking, "Oh, this is the quarter we're going to get disappointed," and they play the game of obviously, if they're going to have to lower numbers, they lower them ahead of time, and then when they report, they're in line or above expectations typically. So that's part of it. But generally, our companies, particularly in the tech sector, have been very resilient. All the doom and gloomers out there that were calling for big earnings adjustments downward have been disappointed. You haven't gotten that. You still have forecasters out there calling for lower S&P numbers, et cetera. But generally, I think earnings are going to hold together pretty good. Not that there's going to skyrocket here because the economy is softening, but I think the companies have a control over costs and are going to continue to report inline numbers with some surprising on the upside, of course. So you got all of that, and it supports stock market, obviously bond market, given my scenario, and the metals market. So yeah, it seems like we're in a sweet spot where they can all go up. Now the funny thing is, people have in their mind that metals only go against stock market, so the stock market has to go down to get metals up, or at the very least, stock market can't be doing much because the metals don't do well in bull market. So that's not really true. You go back to the first decade of this century, and there were periods where they both did very well. There were periods when they didn't, but there were periods. So sometimes the metals move with the markets, and sometimes they go against them. In this final melt-up phase, yes, I think you're going to have both metals and equities going up together.